In the name of God, the most merciful, the most beneficent. Hi, everybody, and this lecture is for CMA Part 2 Strategic Financial Management and Corporate Finance, that is Chapter B, Section 1, the last part. So, we will be covering portfolio theory of risk and return and the capital asset pricing model. In the previous part, we had already covered on individual financial instruments risk and return. So, by these two lectures combined together, and we are concluding the section 1 risk and return under chapter B. Portfolio risk and return. A portfolio is a collection of assets that are managed as a group. It can be simply defined as a mix of two or more assets. It can include any combination of cash, bonds, stocks, mutual funds, or other investments. So, instead of individually managing a risk and return of individual financial instrument, so we put it into a portfolio and we manage it together by mixing it so that there will be a possibility of efficiency and how it is done. So we can understand by the various methods recommended under this. Okay, so we'll see this module and understand how it is and see the benefit of them. But let's see an overall picture of how in the market the portfolio risk and returns are managed. Usually, like for example, they have equity instruments, fixed income, and tactical other things also there. Okay, and what they do is that there will be a mix of these kind of financial instruments mixed within a portfolio, like group of um, financial instruments within a portfolio. So they have, like for example, where there is a fixed income is more concentration and others less. So that means it is, for example, conservative income. So stable and conservative, but lesser revenue, lesser risk also. So like that we grow, like moderate income, moderate balance, and all this. So this is how a portfolio is managed. It depends on the risk attitude as well as the market situation, company, the number of the items, the classification of financial instruments that we have within the portfolio, and the combination of them, and our understanding of the risk and return management within the portfolio. So, what are the objectives? To verify, reduce, mitigate risk of a single security. Once we handle as a single instrument, so there may be a risk, but when we put together, combine together, there are a lot of possibilities of reducing the risk, mitigating the risk, okay, by diversification. All securities in the portfolio may not move together. That is one thing we need to know. So, if within the portfolio, if we have individual instruments which are moving in opposite direction, if one instrument bring loss, another one will bring profit because they are moving in opposite direction. So that's the idea of this. If one goes down, others will go up and compensate for the loss of the first one. So portfolio risk is the risk of several assets when held in combination. So we are having it in a combination. So we see the risk and return of several assets. Risk and return in a portfolio differs from the risk and return concept for a single investment. As I said that because in the several instruments, financial instruments put into one basket of this portfolio, and they may move opposite to each other also because of its nature and their kind and their rating and their volatility level. So that risk and return in a portfolio differs from the risk and return concept of for a single investment. So calculation of risk and return for a portfolio are more complicated than the standard deviation and the variance of a single investment. So for the single investment, we calculate the standard deviation and variation. variance, and the square root of variance is the standard deviation, and thus we get the higher the deviation, the higher the risk. So we can understand that. Okay. So we have to combine into not only one single instrument's risk, but it is a combination of instrument within the portfolio risk that we are studying. So such kind of complication will be there, but there are easy ways to do by if we understand the formulas and how to use them. So that is simple. So the covariance and correlation are useful portfolio measures. So that's what we are going to focus on that in this part of the. What is covariance? It is a statistical measure of the amount by which two securities returns move together. So if there are security A, investment A and investment B, and their measures are moving together. So what is the covariance if one moves, and what is the relationship to what is the effect on others? So that is how we are going to study. It measures the way returns move relative to one another rather than independently. So combined together. A positive covariance means that the two returns move together. This is very important for you to interpret based on this movement. So this is also part of the examination questions. So these informations you have to be carefully read and understand. So a positive covariance means that two returns move together. A negative covariance means that two returns move in opposite directions. So we have to study what is if it is a positive covariance and what is if it is a negative covariance. Covariance of 0 means that the two returns are completely unrelated to one another and they do not vary together in either a positive or negative way. Standard deviation of a portfolio depends more on the covariance of the paired securities than it does on the standard deviations of the individual securities in the portfolio. So it is very important to understand the standard deviations of that along with the covariances of the paired securities. Therefore, a portfolio of securities that are each by themselves individually risky can be a moderate to low risk portfolio of securities if the covariances are low. Low covariances result in low portfolio risk. Okay, so that is that. In order to calculate the covariance of two securities, we need to have probabilities of each possible situation. If what is the percentage of what is the probability of that is occurring? If the return is high, the rate of return is high, and if the risk is high, and if that situation, what is the probability of occurring of that situation? Then only we can get the mean of that, the weighted return. The weighted return means the return, the chance of that return occurring, and the probability of that return occurring. What is the amount of return occurring, percentage of that return, expected return, and what is the chance of that return occurring. So that is the, so with this value we have to calculate the covariance. We then calculate the weighted average of the products of the deviations of each pair of results from their expected returns under each of the possible situations. That's what we are going to see, and we will see with some example with formula. It is very simple to understand with examples. Let's see the basic notation for covariance between random variables x and y is this notation. Okay. Now, the correlation coefficient is given by standard deviation of investment 1 and investment 2. They measures the degree to which the return, the variation, the degree to which the returns of two stocks move in the same direction. So therefore, the correlation coefficient usually referred to as in R as a range from 1 to -1. And this table shows you are interpreting, you are understanding what if the r equal 1 and what if the r equal minus 1 and what if r equal 0. That means the there is the correlation coefficient is 0. So what is that? So these are important point for your interpretation and understanding. Okay, it means that the two investments returns have the past. Always, if r equal 1, they always move together because the correlation coefficient is 1 unit. So they move together as if it is 1, same direction to the same extent. If it is minus 1, they move opposite directions, negatively move. And if it is 0, there is no correlation at all between the two returns of the two investments. So this is the understanding that we should do. This is the main part for students to understand that things. Most of the examination questions are given here, so we have to understand how they move and how we have to take it. How we can, if we want to have a balanced risk mitigation approach, we can select a pair of investments with this correlation coefficients. So that is also important. Okay, important for these things. Once we have the covariance between two securities, we can calculate the correlation coefficient for the two securities using the following formula. So the correlation coefficient for R of two securities A and B, so is given by covariation and divided by standard deviation multiplied by standard deviation of another B security. So if we know the standard deviations of two securities A and B, and if we know their correlation coefficient R, we can use those to calculate the covariance as follows. So this is the formula given. This. If we understand, if we memorize, if we get to know this formula or apply into various examples, we know by heart, and that's for your practice and for your practice for exam also. A portfolio rate of return is the weighted average, as we saw earlier also, is the weighted average of the expected return of all the investment that make up that portfolio. So in the single investment, when we saw that return, expected return, and here, because in the portfolio maybe not one, more than one financial instruments are there, assets are there, and if it is 10, so we have to take the weighted average of all the expected return of all the investments. So that's what here we mean. The weight represents the proportions of each item in the portfolio. That is, the sum of the weights must be equal to 100. So we take the proportion in a percentage manner. So the total weights we have to take it in percentage manner, and we will see in an example. The general formula for the expected rate of return for a portfolio is given here. So we have to see, so this formula, we understand that. So expected return of a portfolio, okay, this is expected return of a portfolio is given by the sum of that weighted proportion or weight of the total funds invested in that security, one by one, item, second item, third item, like that. So that's the weight and the expected return for that security. So that's how we take. This is the percentage and this is the expected return that we calculate. Okay. So if the sum of these percentages will have to be 100, and this return is for the individual returns, expected return. So most of the questions, these informations are given by. So, example, two assets that portfolio have two assets with 40% in asset A and with an expected return of 12% and 60% in asset B. See, in this example, we can understand that in the total weightage will be 100% always. So that is the idea here. Assets, only two assets are there. So if you take the weightage of both assets, it is 100%. Okay, so that's the thing. Expected return also given. The rate of return on this portfolio would be, so we calculate that percentage. So weightage of 40% of 12. So we take in decimal, and weightage of 60% and 18%, which is 0.8, we take it in decimal. So we calculate that. So we get 15.60. So this is the rate of return on this portfolio. So that's a simple calculation. So diversification. The diversification is simply the process of combining assets to reduce risk is called diversification. How do we do that? That is holding a wide range of different investment in a portfolio. So the primary goal of diversification is to reduce the variability or risk of a portfolio. So that we understand that. So the assets, the financial instruments are allocated for diversification. Asset allocation is the process of selecting assets to combine in a portfolio to achieve the best risk return trade-off possibilities. When a sufficient number of assets have been combined to achieve the full benefits of diversification, the portfolio is called a fully diversified or efficient portfolio. So these are the terms that you should understand for your practical professional life, as well as from the examination point of view also. What is meant by fully diversified, or what we can call it as an efficient portfolio. An efficient portfolio, this is very important, most of the questions are based on that. An efficient portfolio is one that gives the highest rate of return for a particular level of risk, or the lowest level of risk for a particular rate of return. See, if the rate of return is high, then it has to have the lowest, either it has to have a lowest level of risk or highest rate of return. So if we want to focus on the return side, it has to give the highest rate of return for a particular level of risk, for a particular level of accepted level of risk, we can calculate. Or for a particular accepted level of return, it has to give the lowest level of risk. So that is the idea, that is the efficient portfolio. Okay. So we have to determine one and go for the high. So if we determine the risk level that is acceptable for us, so we determine among comparatively, we go in which return, if both are having same, assuming that the risk level is the same and which is acceptable for us, and we go for selecting the highest level of return. And if we are focusing on the return level, okay, we satisfied with this return level, and we focus on those risks in which they are giving lesser risk, so the lowest level of risk. That is the efficient portfolio. Okay, so that is idea we have to do it. It does not mean that risk has been eliminated. So we can never reduce, totally eliminate the risk. We can only reduce, mitigate. Mitigation, reduction is the kind of, we can say that it is the mitigation also. It's not totally, we cannot, eliminate a risk. Risk has just been minimized for a particular level of return. Let's see the roadmap for the level of risk and higher risk. So how we can see that practically. For example, an investment in a company that is cyclical, its returns move with the economy in general. It can be combined with an investment in a company that is counter-cyclical. Its returns move in the opposite direction. That's why it is called counter-cyclical. One move against. Risk reduction can be achieved in a portfolio when the securities held are not correlated with one another. So, market risk, that is called systematic risk, cannot be diversified away. So we know that. That's a point that we already know that. Okay. And the table, we have to see this table. It shows the most common types of investments ranked according to the level of risk. We are looking at US environment. Let's say the lowest risk will be in the US Treasury bonds. And then the first mortgage bonds also, we can see this. Then little higher the risk will be the second mortgage bonds or subordinated debentures, and then income bonds. We studied already all what is meant by income bonds and all these things. Then move on to the stock, which is preferred stock, and the more return that we go, then it will be higher risk, which is convertible preferred stock and common stock. A portfolio's total risk consists of two specific types of risk. One is systematic or market or undiversifiable risk, we studied already, and unsystematic, that is company based diversifiable risk. In principle, diversifiable risk should continue to decrease as the number of different securities held increase. Supposing, so if they are opposite to each other too, so it will minimize. Okay, the risk will be minimized. In practice, the benefits of diversification become extremely small when more than about 20 to 30 different securities are held. This is very important. The small is better to manage. So if you are complicating ourselves having more than 20 to 30 different securities, then we cannot expect that kind of diversification benefit. So that is also important. This is also part of the exam questions that we need to understand that. The more we will be having complications. Also, if we have more stock, then there will be commissions and other transaction costs also increase with the greater diversification. So just because of the risk mitigation or diversification purpose, if you are accommodating more securities within one portfolio, then these are the disadvantages that we have to face. So let's see a question. A feasible portfolio that offers the highest expected return for a given risk or the least risk for a given expected return is just we studied just now. Okay, so if you can remember, then we can see these things. So it is option C, as one of you have answered that correctly. So option A is not correct because optional portfolio is when you select from the efficient set of portfolios because it is tangent to the investor's highest indifference curve. So that what is this means? It is not at all from the indifference curve. It is not at all touching upon that. It is just deviating from that. And option B and C are nonsense because there is no such thing like desirable portfolio. I like whatever I like, I do. There is no such kind of thing in an intelligent business management. And effective portfolio also, it is not that. It is only the efficient portfolio. It becomes effective. So that is different. Okay. So they are nonsensical from the technical point of view. So efficient portfolio is the one that we are looking. A feasible portfolio, efficient portfolio is a feasible portfolio that offers the highest expected return for a given risk or the least risk for a given expected return is called an efficient portfolio. So option C is correct. So we will now have to calculate another measurement tool in order to calculate the portfolio risk. It is called market risk, is the risk of the stock market as a whole. So what is the measurement tool that we calculate it? Where most knowledgeable investors diversify. So based on that, an individual investments contribution to the risk of your portfolio is a function of how that investment is most likely to be affected by a general market movement. See, market, the systematic risk cannot be diversifiable, but individual investor reacting on the market movement, how he is reacting, his contribution to the risk of a portfolio can be measured, that is called beta. It describes an investment sensitivity based on that. It describes an investment sensitivity to market movements. It is a quantitative measure or index of the volatility of a given investment relative to the overall market. So there are so many individuals reacting on one investment instrument based on the market situations. So they combine together, so the market movement on that particular investments, and it is a quantitative measure that is called beta. It is an index. It is an index of the volatility of a given investment, how volatile it is relative to the overall market. If the market is picking up high, if that particular investment also going in that direction, or at what rate. So this is the important point that we learn from here. This sensitivity is stated in terms of stocks beta coefficient. Particular stock beta coefficient is given here. So let's see with this and how can we calculate a portfolio risk also in here. So market risk and beta, a stock with a negative beta would move counter to the overall market. If your beta value is negative minus, so that means the market, whatever the overall market is moving downward, so this particular stock will be moving upward. So that's what the idea. If the market is moving upward, it will move downward. The systematic risk of a well-diversified portfolio is proportional to its beta. A diversified portfolio with a beta of 1 has half the systematic risk of portfolio with a beta of 20. So we will study with this with some examples. Okay, an example question. A market analyst has estimated the equity beta of NSME to be 1.6. This beta implies that the companies and what is the right choice. If this beta implies that the company's systematic risk is lower than that of the market portfolio, or systematic risk is higher than that of the market portfolio, whether it is unsystematic risk is higher than that of the market portfolio, and total risk is higher than that of the market portfolio. So the right answer is option B. Systematic risk is higher than that of the market portfolio, because the effect of an individual security on the volatility of a portfolio is measured by its sensitivity to movements by the overall market. Okay, so we know already if the beta is 1, if the beta is equal 1, it is going along with the market situation. Okay, the market portfolio. But the given beta is 1.6, which is above 1. So therefore, it is higher than that of the market portfolio. Next question. What is the formula for the beta coefficient of a security? We have just seen that formula. We have to just recall it from our memory, and therefore we get that. So there are various options are there. We call that. So the right answer is the covariance of the returns on the market and the security divided by variance of the return on the market. Because the word beta is derived from the regression equation for regressing the return of an individual security, that is the dependent variable, to the overall market return. The beta coefficient is the slope of the regression line. So the beta for a security may also be calculated by dividing the covariance of the return on the market and the return on the security by the variance of the return on the market. Why other answers are incorrect because beta equals the covariance of the returns on the market and on the security divided by the variance of the return on the market. But other options are a wrong calculation because they are multiplying. Okay. So based on the following information about stock price increases and decreases, make an estimate of the stock's beta. So July stock was plus 1.5%, that means increasing, and market was plus 1.1%. And in August stock was plus 2.0 and market was plus 1.4%. September stock was minus 2.5% and market was minus 2.0. So what if the beta, if the beta is greater than 1 or beta is less than 1 or beta equals 1, there is no consistent pattern of returns. So what is there? So actually when the stock is 1.5 but market is 1.1, that means definitely the beta is greater than 1. And in August when the stock is 2.0, when market is 1.4, it is still the beta is greater than 1. But September stock is minus 2.5, market is minus 2.0. In all these things, the beta is greater than 1. Because beta is greater than 1 is correct. Because beta measures the volatility of the return of a security relative to the returns on the market portfolio. In each case, the stock price increases or decreases was a greater percentage than the market change. So therefore, the beta of the stock change over market change is greater than 1. A company, another question, a company holds the following stock portfolio. So the stock portfolio W, X, Y, Z, they are instrument names, okay, stock names. And portfolio and the total beta coefficient, both are given. Okay. So 20% is the, so if you add this, the weightage of this portfolio, it is 100%. You remember that we discussed about that. And the beta coefficient is given already, 0.8, 0.6, 102. So the beta of the portfolio. So now we have to find out the beta of the portfolio. So how do we do that? The answer is, the right answer is the C. The beta of a portfolio is the weighted average of the betas of the individual securities. What is the weight? The weight is the portfolio percentage. Within the portfolio, what is the percentage that it has? That particular instrument is there. So therefore, we multiply by the weightage of individual beta values, and aggregate of that is the sum of that is the beta of the portfolio itself. Okay, capital asset pricing model. Capital asset pricing model is an economic model for valuing an investment portfolio by relating risk and expected return. This is also one of the models to find out the value of the investment portfolio. It is based on the theory that investors demand an additional expected return, also known as risk premium, when asked to accept additional risk. So whenever there is a high risk area, they need additional investment. For example, when they are staying at one particular return at particular specified risk level, and if they have a new addition of another risk level, so they need additional return also. So that is the thing. It is based on the theory that investors demand on additional expected return, also known as risk premium, when asked to accept additional risk above that found in a risk-free investment. So when you want to be risk-free, you just stay with treasury bill like kind of things, or fixed deposit kind of things on a stable environment. or defaultless environment. So that, but then you go into accepting risk with certain income return level. So that is the idea. So therefore, the CAPM formula is the expected rate of return equal the risk-free rate of return plus the beta of the expected rate of return of the market minus the risk-free rate of return. So what is here you should understand is that in order to find this CAPM formula, the expected rate of return, actually you should take what is the risk-free rate from the market, take that, and what is the beta level of that market, and then what is the expected return on the market portfolio, okay, for that. So you can arrive at this by using this formula. So the here we see the risk premium, beta, and security market line graphic. The greater the risk of the firm, the higher its beta will be. The higher the company's beta is, the higher the return investors will require in order to hold the investment. So in order to understand that, we should study this security market line. The graph of the CAPM equation is called security market line. This line tells us what investors' required rates of return are at each level of risk. So risk is given by the beta value. If the aim is to keep portfolio risk low, investments having low betas should be included. So that's all. Conversely, if a higher return is desired, investments with high betas should be added to the portfolio. The capital asset pricing model calculation can be used to find the required rate of return on a stock or portfolio when the return on a risk-free investment, the beta of the stock or portfolio, and the return on the market portfolio are known. So with this information, we can attempt some questions also, so that we can better understand this. Capital asset pricing model versus arbitrage pricing theory, which is called APT. So for calculating CAPM, it is easy that we get the market risk-free rate of return and market expected rate of return and the beta value, so that you can calculate the CAPM. But whereas the arbitrage pricing theory is an alternative to the CAPM that uses fewer assumptions and can be harder to implement than the CAPM. Why? Because while both are useful, many investors prefer to use the CAPM because it is a one-factor model. Okay, but APT is more complicated. It requires more quantifying multiple systematic factors. So that is why CAPM is more prevailing in the calculation. Okay, capital asset pricing model question. For example, the RF, that stands for risk-free rate of return. So 8% is the risk-free rate of return, maybe US Treasury bill kind of security rate. And beta value is given like 1.50, that is the beta coefficient for the company. And the estimated return on the market portfolio is given by RM, so that is 12%. So with these, we can calculate the CAPM formula. The formula is already known, is this. So we apply this value. So the percentage we put it to decimal, and we apply this formula, and we get 14% as the CAPM value. Let's read this question, little interesting one. So the stock of company Z has a beta coefficient 20 and an expected return of 16% using the capital asset pricing model. So the expected return also done using the CAPM formula. Okay. Now, what is missing in this is the rate of market return. Okay. The stock of company X has beta coefficient equal to 0.8, uh, 0.8, and the risk-free rate of interest of the market is 4% is given. The expected return on company X is to be found now. So in order to find, if you use the solution, first we have to understand the CAPM formula. So we need the return, the expected return of this for the X stock equal by the risk-free rate of return, which is already given 4%, and beta value of X also has been given, which is 0.8, and the market return is the one that we have to find out for the portfolio, okay, where we have X and Z both, and the risk-free rate is already given, which is 4%. So first what we do, because for the company Z, almost all the values except the market return for the portfolio, sorry, is not given. So applying the formula, we can get that the return on the market, the return from the market for the portfolio itself, and then we apply that for the company X. That's the idea. To put values to this equation, we are given with all except the market return for the portfolio. That is the only thing that we have to find out. So first we find the RM. So by replacing the values, so we get the expected return, which is 16% equal to 4%, which is the risk free, and then beta coefficient of Z company is 2 multiplied by RM minus that 4%, which is the risk free rate of return. Therefore, we get the value of RM equal 10%. So now we got that RM, so we apply for X, which is 4% is the risk free return plus beta coefficient 0.8 and 10% minus 4% equal 8.8%. So that's how we get that. Okay, another question. This is very tricky question. Don't need a calculator if you understand well the concept. If the covariance of a stock A with stock B is minus 0.0076, then what is the covariance of stock B with stock A? So there are relationship of stock A and stock B. Here, if the stock A with stock B relationship is given, and what will be the stock B's relationship with stock A? And the answer is either it will be, here it is minus, and whether it will be plus, or it will be the same, or it will be greater than, or it will be less than. So this is the answer. Option B is correct because the covariance of two stocks is the same regardless of which stock is compared to the other. So try to understand this point very well, and so it will be a very easy question. Okay, this is an interesting question. Looks like complicated one, but it's very simple when you understand. It's a kind of story, so you just read carefully, and you will be able to answer. An US company currently has domestic operations. So they have only domestic operations only. It is considering an equal size investment in either Canada or Britain. The data on expected rate of return on the risk associated with each of these proposed investments are given. So the expected rate of return and the standard deviation is given for British investment and Canadian investment. So 22%, 10%, 28%, and 15%. The expected rate of return on the company's current domestic only business is 20% with a standard deviation of 15%. Using the above data and the correlation coefficients, the company calculated the following portfolio risk and return based on a ratio of 50% of US domestic operation and 15% of international operations. So what is the difference between the previous one and this is that earlier it is only domestic only operations. It is only domestic only operations, and here the 50% for US domestic operation and 50% for international operations. So in this situation, to see the company plans to select the optimal combination of countries based on risk and return for the domestic and international investments taken together. Because the company is new to the international business environment, it is relatively risk averse. Okay, so based on the above data, which one of the following alternatives provides the best risk adjusted return to the firm? So whether it is to undertake the British investment or undertake the Canadian investment or do not undertake either investment, or you are unable to determine based on data given. So this is what we have to find out. Now answer A is correct for that. Let's understand why. Because the US company is risk averse. So naturally they will select the investment with a lesser risk. Thus, by choosing to invest in Britain, the overall rate of return will increase from 20% to 21%. And risk based on the standard deviation, which is given already, will decline from 15% to 3%. This gives a better return per unit of risk as compared to the Canadian investment. We can also verify by simple analysis also. Simply by looking at that, see, what we should understand is that the question says that the company is relatively risk averse. Okay, so they are expecting lowest risk level. So if you go by these things, the Canadian investment, the risk level is 15%, and in the domestic market only, and also in the domestic as well as international, like US and other countries. So that is 15%. So the risk level is the same. But if you notice that the lowest risk, the standard deviation is the US and Britain. So that is the investment in Britain. Okay, with 50% in US and 50% in Britain. So that is only 3% standard deviation. Compare the same thing with the domestic only market, the standard deviation is 10%, too big difference. So that is the higher risk than this one. But the expected rate of return is slightly 21% here and it is 22%. But anyway, within the current domestic only business is 20% and we are getting better return in 21%. So therefore, this option is better. Another question, using the capital asset pricing model, the required rate of return for a firm with beta of 1.25 when the market return is 14% and the risk-free rate is 6%. So we have to calculate. So we have all the values to calculate the CAPM formula. So according to that. So answer D is correct. Why? Because the formula when we apply, which is the risk-free rate of return is 6% plus the beta value is 1.25 multiplied by the difference between the market return 14% minus the risk-free return 6%. So accordingly we get 16%. Which of the following is the major difference between the capital asset pricing model and arbitrage pricing theory, APT? It is called APT. So CAPM uses discounted cash flows, whereas APT does not. CAPM uses a single systematic risk factor to explain an asset's return, whereas APT uses multiple systematic factors. APT uses a single systematic risk factor to explain an asset's return, whereas CAPM uses multiple systematic factors. And under CAPM, the beta coefficient of the risk-free rate of return is assumed to be higher than that of any asset in the portfolio. Under APT, the beta coefficient of every asset in the portfolio is individually compared to the beta of the risk-free rate. So, the correct answer is option B, because CAPM uses a single systematic risk factor to explain an asset's return, whereas APT uses multiple systematic factors. So that's the only major difference between these two. Thank you. And by this lecture, we conclude the chapter B, section 1, which is risk and return.